Hey everyone, it's John Parisi. Today is Friday, May 17th. Our last video to you was on March 28th, about a month and a half ago, so it's been quite some time, and it's been a really exciting time. And a lot of what we talked about has already happened, and we moved to the other side. In the last video, again, about 6 weeks ago, right at the market peak, we said, look, investors need to be prepared for a 5 to 10% pullback. It could start imminently, or it could happen anytime in the next several weeks or a couple of months. And that we would be confidently buying into that pullback with cash we've been sitting on. We have been in a hold for a long time, and when we're in a hold, it means we're sitting on blocks of client cash, new clients, money coming in. We're not putting it into the full allocation. We're either doing it a little bit every month or we wait for a dip. Well, we got a 5.9% pullback, and on April 16th, we did a video on March 28th. On April 16th, we on our screens, this can be found on our website. I'll get to that in a minute. We turned back to a short-term buy signal, and we spent the next week and a half buying into stocks for our clients. And we were sitting on a lot of cash, and we've had quite a few new clients come in at the beginning of the year in this first quarter. So we took that break as an opportunity to get their money into our portfolios, and the market would trade off from April 16th to the 19th is where it bottomed. But then, as we said, kind of the selling pressure begins to evaporate, and then you see the market just one day stops and starts trading up. There is 6 to 9 trillion, I've heard numbers all over the place, of cash sitting on the sidelines waiting to come into the market. Everything from big institutional money, pension money, life insurance money, all the way down to small retail investors. So that is a powerful catalyst for stocks. You can follow where we are buying, selling, holding on our website at the Market Insights section. If you scroll down a little bit past the previous video, you will see it's called the S&P 500 running chart, I think we call it on there. And you can always just pull that up. In fact, before these videos, I suggest you open another browser and pull it up. And then as we're talking, you can kind of see the dates that we're talking about here. But we try to be transparent. We are now, this market is really strong, so we're going to respect it. We had a 5250 for the S&P as our year-end target. We're now above 5300. I think it hit 5360 this week. The Dow crossed 40,000 for the first time. The S&P, the Nasdaq hit an all-time high. So we're, we've been bullish, but this is really bullish. We're going to respect it. We're going to kind of stay out of its way. As we said, the market keeps going up. We're just going to ride what we own higher. We're going to use opportunities and breaks in the market to add more cash to equities. We love bonds in here. We are extending our maturities from 1 and 2 year notes out to 3 to 5 year, 7 year notes. We're not going to talk about that now, but we think that could be really profitable over the next year and a half to 2 years as the Fed begins cutting rates. I want to talk a little bit about what's going on with the Fed. Their last meeting, they paused. They did not increase rates. They did not cut rates. The market expected them to do nothing, but the market broke down hard because they didn't talk more about being aggressive in cutting rates, which would be bullish for the economy, bullish for the markets. But they did something that the media completely missed, that we jumped on. And that is that they said that they, instead of selling $60 billion a month into the bond market of bonds on the Fed's balance sheets that it bought during the COVID crisis and the financial crisis, they would go from $60 billion a month of selling to $25 billion, more than half. And that is hugely bullish for the market. The Fed can't cut rates when they're quantitative tightening on the other side of their balance sheet. So they can't cut rates while they're still issuing supply into the market. More bonds means lower bond prices and higher yields. So they got really ridiculed because when they first started raising rates, they were still buying bonds out of the market. So they're not doing that. Well, this is the first sign the Fed wants to cut. The Fed wants to cut. Wall Street's a funny place. They were talking about 6 or 7 cuts this year. We couldn't figure that out. We said from the beginning of the year, we think 2 cuts, maybe 3 if inflation really begins to drop and the economy slows. Over the course of the last 5 months, the street then got to, maybe it'll only be 3 or 4 cuts. And then it went to, maybe it will only be 2 cuts. And then around the Fed meeting said no cuts this year, and maybe they need to hike more. And we've just stated our 2 cuts, maybe 3. And we feel really good that they're going to do that. We do believe the Fed wants to cut rates. They want to help the banking sector out. They're still out of alignment from last year's banking crisis, SVB bank failure and other failures. The commercial real estate market is still in trouble. That is all financed with now very expensive rolling debt. So the banks need to add, the Fed wants to add some relief to that sector of the marketplace. So we're staying right where we are. We're going to take our year-end target of 5250, put it in our back pocket. We are going to be buyers on weakness this year. We'll hopefully get some noise around the election. We're not going to be really sellers on strength, but we will go to a hold. So next week I'm going to go to a hold. I'll probably do it around the 22nd. I think it's Tuesday, because NVIDIA comes out with earnings and we should run into that. But again, NVIDIA's earning, Wall Street's a funny place. NVIDIA, they're going to make this much money. Then they're going to make this much money. And the street just keeps ratcheting it up, right? From here, and then they come in here and they trade the stock off, even though they started much lower. So we're going to use that as an opportunity to add to tech stocks in here. It's not just techs, people. It's energy is doing great. Financials are doing great. This is one hell of a stock market. We're going to respect its strength and just, enjoy it. So that's really it for today. Next week's going to be Memorial Day. We probably won't do a video between now and then. We might if something exciting happens, but if not, hey, we're starting the summer. We're going to wish everyone a happy Memorial Day. Have a great weekend this weekend, and we'll talk to you soon. Thank you.